Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, BrokersAlliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the whiz of the biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone.
Our email is thebiz@brokersalliance.com, or you can call us at 1-800-290-7226, 147 for any of your life, DI, LTC, annuity, and or group pension plan quotes. Remember, I'm not a tax advisor or a CPA or any other kind of legal fiduciary. So if you hear anything on the show that's a great planning strategy, don't forget to check with your attorney, your CPA, and if you're with a broker-dealer, of course, your compliance officer. I'm with today Marcy Pruitt, head of our disability division for Brokers Alliance. We're talking all day long about all that is disability, right? And today, on our first segment, I want to talk about this, and I think it's a definition issue. That's why I want to flesh this out today. Marcy, own occ. I might have a regular blue-collar job. There's classifications here, or I'm so specific as a surgeon, I need to protect my ability to do surgery, even if I could actually teach medicine. So give us a little walkthrough on own occ, a little bit of the definitions from an industry point of view, and then we'll break down these divisions.
Okay. Well, there's 3 or 4 levels of own occupation protection. The lowest tier is your any occupation, and that is, as you mentioned, blue collar. Basically, after typically 24 months, any occupation that you're reasonably suited by education, experience, or training, the carrier is going to want you to go off claim and go and do. That is typical in your real blue-collar policies. In most group policies, it's written that way as well. The modified ONOC, which is your middle of the road, covers the masses. It's a great definition for most individuals, would be unable to perform the important duties of your occupation and not gainfully employed. Now, that isn't like any OC. They're not requiring you seek gainful employment, but if you do elect to go out and seek gainful employment, then your claim would be reduced by your new income. Mm-hmm. And if you're not highly specialized, that covers you sufficiently, because in the true specialty own occupation, as you mentioned, that protects you in your specialty. So if you're not highly specialized, what would you go do that's outside of your specialty? That's why modified ONOC is satisfactory. The surgeons, the attorneys, they're looking for that specialty ONOC, and they will be as specific as the specialty that the AMA recognizes.
So if I had a litigator that was huge in the courtroom, he had verbal skills, transmission, communication skill sets, highly tuned, and he somehow, some way could not speak any longer, but he could still process work in the office. He could probably write emails, do briefs on it, but his specialty was litigation in a public setting. He would actually be specialized.
Right. Absolutely. So, and you can have the specialty for as a litigator. So if you could do other areas of law, but you are unable to perform in the courtroom as a litigator, then you would be considered disabled.
Okay. So, and the same thing with as a physician, he could always default to a general practitioner, but if he can no longer do open heart surgery, as an example,
right, or
orthopedic surgery, he was very specific. Brain surgery,
and even in orthopedic, they'll be very specific and say hand surgery, or if you have a specialized area within your specialty, it can be that specific. So
the definitions per carrier have to be pretty tight. I mean, you have to pretty much know that. And in our area, don't you feel like sometimes, Marcy, you're an attorney almost? I mean, you have to understand these definitions, right?
Right. And if you were to put a room of specialists or experts, and I have peers that are expert witnesses at trials, there's a variant understanding of that, and it really boils down to what are you doing at the time of disability, what are your duties, and where does your income come from? So because even if you buy a policy that's an ONOC specialty for something, and then you go into a new field, it's what are you doing at the time of your disability. So most of the leading carriers, even if there's not specialty definition, that's what it boils down to.
Is there we have so many carriers in our inventory of disability companies. Is there a carrier from an ONOC specific, let's just do specialty first, specialty that you say, they're very good about definitions, they're very good about underwriting. If you have a specialty, I'm looking at this carrier.
Yeah, there's 3 carriers that actually put the specialty language in the contract. The others will typically say, as I mentioned, what were you doing? What's your occupation at the time of disability? What are your duties, and where does your income come from?
And what 3 would that be?
Well, the Guardian, Standard, and Union Central are the 3 that will lay out a specific specialty
now
in the contract.
I think and Union Central.
Yes.
Okay. Well, if I remember, and please correct me, I'm just going off my memory, Standard's been in this game a long time.
Absolutely.
So is Union Central, and of course the venerable Guardian. I mean, they've been around forever. So these 3 really have specific language. So if you have that kind of specific specialty, if our advisors are listening to right now, can they call you to say, is that going to qualify for a specialty ONOC?
Right, absolutely.
Okay.
And they really follow off the AMA list. After recognized specialties under the American Medical
Do you have that
Society.
list?
We do, yes.
So if anybody want to call in, they could just
Sure.
ask you for it. Okay, again, if you want to call Marcy direct, 1-800-290-7226. Her extension is 126. Her email is marcy@brokersalliance.com. And just call her for any of the things we're talking about, especially like this list. And you're really interested, I have clients that are in specialty items. I do believe in what you guys are talking about as far as paycheck protection,
Right.
that I want to introduce it into my practice. I want to insert it into my financial planning now. So I want to make it part and parcel of how I look at indemnification when it comes to protecting my client overall. So when I'm looking at ONOC and I go down to modified, now I noticed that, did you say the 2-year, actually before I go to modified, yet the 2-year blue collar, kind of everybody, that doesn't go off forever. They only say for a shorter period of time.
Right, 24 months, maybe 5 years, typically 24 months.
24 to 5 years.
Right.
Is that a good market to go after, Marcy? Is that an average market? What kind of market is your 2-year blue collar, pretty much, anybody's occupation?
Well, I mean, that's a good market if they need income protection. A lot of real blue collar may have some kind of group, weekly payroll deduct type policy. They're typically limited benefit policies, accident only, or specific illnesses, or off the job, offsets against workman's comp. But, if you're in that market, I mean, they need paycheck protection.
If you were hurt on the job, got workman's comp, would your DI still pay the full amount, or will it be a difference? Would it be the
It
offset?
should pay the full amount, but the contract will specifically say whether it's offset. Most of your white-collar, professional, skilled, technical type policies you sell, you do not want that offset in there.
Right. And do you see anybody in the blue collar that plays pretty well in underwriting, gives them pretty good backs, they won't have the offset? Who's that?
Assurity, Illinois Mutual, Mutual of Omaha. They're 3 good ones in the blue collar marketplace.
And Mutual of Omaha.
Yes.
Okay, the Wild Kingdom. Carl
Absolutely.
Perkins. Yeah. Well, when I'm looking at, now let's go back to this middle ground, this modified.
Well, and in addition to modified, I wanted to say because I had said 3 or 4. The 4th is a transitional loan OC, and that's important to note because
What's that about?
that's like your specialty, but once you hit 100% of your new earnings combined with your disability benefit, then it begins to offset. So it's a step up from modified, maybe a step down from specialty, where you can only double dip, so to speak, until you're at 100% of your pre-disability
So
earnings.
the trans is like, well, you have specialty, then you have trans, then you'd have modified, then you'd have at the
Right.
bottom end what would you call the
ENEOC.
ENEOC. Okay, ENEOC.
And it's not just the specialty ONOC. I kind of want to go back to that. For certain physician specialties, that's important, but you also look at the price, can it be underwritten, and the combination of riders that are available when you do that. And, so it's specialty ONOC is important, but those carriers that, other than those 3 I named, they have own occupation protection. They just don't have the specialty language in the contract. But again, at the claims time, their interpretation is if you earn your income and your duties are in a certain specialty, they're going to adjudicate the claim in favor of the client, but again, it's not laid out in the contract that it's specialty language.
Marcy, do you have anything that's like an attachment that we can send to our advisors if they request that kind of outlines the four basic language so they kind of see where it is so they can make a judgment call before they start talking to their client?
I believe so, yes.
Okay. Well, again, if you want to pick that up, it's just Marcy at brokersalliance.com or her toll-free number,
Right.
1-800-290-7226, extension 126. When I'm looking at modified, I want to go back to that now, just to make sure I covered it. On modified, I'm trying to put my arms around the idea that I'm going to have some exclusions on this, right? I might, or not necessarily.
No, not modified underwriting. Modified own op just means it's your election to seek gainful employment. If you seek gainful employment, your claim will be reduced.
Well, what would be the motivation to seek it then?
Well, a good question, and you're never forced to, just to be productive. And again, if you were making X amount, and if you purchase the full amount you were eligible to do, that's going to be roughly 60%. There's also a cap, so depending, you probably have a shortfall. You want to go back to work to make more money.
Or your investments are making up the difference and you're going to stay on the sidelines.
And you can, and that's why the policies are very comprehensive, very excellent language, much stronger than you find on a group basis, which you pay more for individual policies. And that's why at the time of underwriting, they're very strictly underwritten, like we talked about some of the underwriting aspects of it, because once you purchase that policy, it can't be taken away. And
it's, again, on a modified, I just want to make sure it's elective gainful employment.
Right.
So the definitions are pretty tight on that. And it got to carry your choice?
They all have that.
Oh, they all have it. So there's not one over the other. So, okay.
Not for modified.
All right. Well, listen, coming up in our next segment, we're going to take disability, the contract chassis, and then we're going to start talking about riders that can go on top of these chassis. You can order any of the things we're talking about from Marcy. Say, I need an explanation. Just write her, Marcy at brokersalliance.com, or call her 1-800-290-7226, her extension 126. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. We'll be right back after this break.
Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new.
Well, welcome back to the Business Insurance Zone, the talk show that spotlights insurance in your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. In this segment, we're going to talk about all the riders that you can put on a disability chassis. I mean, all in. And there are some that are incorporated into the contract, some that you actually have to pay. You're going to have to make a decision whether there's economic value per rider. And of course, with me again is Marcy Pruitt, who heads our entire disability division in Brokers Alliance. And I can't imagine, if you took every rider by every carrier that we have and split them between no cost incorporated into the chassis versus, no, these are individual, we'd have to actually break out our HP 12C and actually do some math to see, is that worth it?
Right.
So let's talk about most of the riders that are already incorporated on these chassis, on these basic disability, just to kind of get, those are pretty much standard operation, and those are the ones you always find.
Okay. Well, guaranteed renewable is, and they really varies carrier by carrier. So non-can guaranteed renewable.
Non-cancelable. They can't cancel on you.
Right. And non-cancelable and guaranteed renewable. That would, not only can they not cancel, but non-can actually means they cannot raise the premium. That is built into some carriers. Others, you can pull the non-can feature off and it will reduce the premium by about 25-30%. And so again, non-can means that the premium cannot increase. Guaranteed renewable, the features and contract cannot be canceled.
When I'm looking at the difference then, let's just talk about the spread. You said it's about a 25% spread between that and what was the second? From non-can versus?
Guaranteed renewable.
Okay. So if I'm looking at that, I mean, I'm thinking 25% premium difference. How many times as a carrier, I know we can't look into the future, but I'm just thinking basically on the historical past, have they raised their rates enough to make you cringe and say, no, I'm doing the guarantee?
Absolutely. They really have not. And it requires that they file with the state and prove loss ratios. And that's just not happened. In history, yes, it's happened once or twice, but not, and there's reasons for that, the type of policy, et cetera. And that was early 70s. Really, the carriers have not increased their rates. What they do is they open a new policy series with new pricing and new features, and that's what they start selling moving forward.
So have you seen over your history, I mean, you've been in this game a long time, have you seen the carriers pretty much never approach that 25%? So if I started out at $5,000 and I had adjustments over a 10-year period, I never got to that 25%.
Right, and you wouldn't have adjustments like that. It would be a one-time shot where they filed with the state and everyone in that occupational class was increased. It wouldn't be a continual adjustment. So, and that's why today we see more policies being sold on a guaranteed renewable chassis because, as you just said, especially because females are rated higher, and if you have individual females and maybe in their early 50s, we're promoting the guaranteed renewable because how long, they keep the policy 10, 15 years, and it's unlikely if they were to get an increase in the future, all the premium they would have saved, they're probably still ahead of the game.
So the older if I'm hearing correctly, the older I am, my timeline's shorter of how long I'll have my disability contract, 65, 67. Actually, there are some contracts, though, that go, right?
Right.
I mean, renewal, as long as you're working and you can prove you're working full time, that go out to, I think you told me some astronomical, I was watching your teaching video, and I think you said something like, what, 75, 80?
75, right.
Was it 75 as a cap?
Some will go lifetime, but 75 typically.
As long as you have gainful employment. I mean, I didn't even thought about it. I always thought disability died at 65. But if I had my timeline, and I'm looking at a 10, 15 years, the odds of it actually increasing up to 25% is pretty remote. I mean, it could happen.
Right, it could happen,
but it's remote. Okay, based on that number, and I'm looking at the bang for the buck, I may want to go this other way then.
Absolutely.
So when you see sales, what's it going right now? Is it pretty much guaranteed or no?
We're seeing more, again, in the older market. They're willing to take that chance. You want to be sure that you explain that what can happen.
In blood.
Yeah, sign off on it. Put that disclaimer there. But, we have not seen the increase like you've seen in long-term care policies or even years ago universal life policies.
Is it fair to say, and I don't know if this is fair, but I'm asking you, is it fair to say that really underwriting DI has become a really great morbidity science, and that's why you don't have these increases because they really know how to price it day one?
Well, they do, and it's not, they underwrite it. It's not tied. It's not cash accumulation. It's not tied to the interest rate. Certainly, that's how carriers make money, and their return on equity, they shoot for a certain percentage, but they are pricing it and underwriting it so that they hit the ROE level they need to hit, which is why, they don't even go to the states for the increase. They close the series down and open a new one because they don't have the loss ratios to prove to a company, to the state, that they deserve the increase.
When I'm looking at riders that cost me money now,
right?
Okay, let's talk about that for a second. Let's talk about the two most popular that people are willing to pay a little bit more to put this on their DI contract, because you think there's some economic value
Right.
to that. Talk about the first one.
Well, the residual, we talked about ONOC, and depending on what ONOC rider you add, it could add 25%, but it also, depending what happens to the mental, nervous, drug, alcohol provision, that kind of washes it out, and that can either be an unlimited provision or a 24-month limitation. So otherwise, residual is a very important rider. It will pay in the event of a partial disability where you go back to work and you're suffering a loss of income. And again, most claims can.
Well, you're going back to work in your occupation, or just going back to work?
It can be either one, depending on your own op.
Maybe
You're going back to
gradually
work.
going back to work, so it's going to pay the difference.
Right.
Okay, it's going to modify.
It'll pay a proportionate amount of your. If you're suffering a 50% loss of earnings, it pays 50% of your benefit.
In residual, what kind of a price tag have you noticed? Is like
That's kind of high because many claims are residual in nature. 25, 30%.
increase on the chassis.
On the chassis.
To make sure you're covered on that.
Correct.
And do you see a lot of people purchasing it then? Because that's kind of
Yes.
pricey, but
Well,
they're still purchasing it.
Because most claims aren't total in nature. And back to the ONOC claim, and this varies carrier, but industry-wide, true specialty ONOC claims are only about 2%, because
Now,
they
that surprises
either
me.
don't go back to work or they go back in what they know how to do. And ego, from an ego standpoint, an orthopedic surgeon, if they can't do orthopedic surgery, are they really going to teach? They may, most of them retire, or they go back to what they know how to do.
So I wonder if their egocentricities are specific to their occupation. No, I guess not. Give me another rider that we're
Cost
willing
of
to pay some.
living, that's a 10 to 15% load. And that can do a lot. If you do not add the cost of living rider, your benefit will be frozen for your entire claim duration. And if, especially a young professional, if you think inflation's going up, that is a good rider to have, because a $10,000 benefit today won't be worth $10,000 5-10 years from now.
And I think some people may say, hey, 10% more of whatever the contract or the policy's base cost is. That's a pretty good idea.
Right.
I mean, especially the younger you are, I think you're
Right.
right. I think the timeline proves that that's an economic. What other ones would you want to put on there that might be of value?
Today, the catastrophic rider is one that we're seeing more of, and that is it's about a 10% load. That will pay an additional benefit on top of your base benefit if your disability is catastrophic in nature.
Now, I noticed this language. I'm just asking because I just want to make sure everybody hears this right. To qualify on the issues of activities of daily living,
Right.
is that the same as it is in long-term care?
Same premise, yes. It's if you're suffering the loss of two of your activities of daily living or cognitive impairment, so like long-term care essentially, they will give you, depending on how your contract was set up to $8,000, and that's spelled out in your contract, or 100% of your income.
Do you have the list of the 6 ADLs in your office?
It's the same as long-term care. That's
Same.
bathing, dressing, transfer, incontinence.
If you don't have it, of course, just
Call.
Marcy at 1-800-290-7226. Her extension is 126, or just write her on email at marcy@brokersalliance.com, because we always we talk about
Right.
these things and we say, yeah, we have it, order it.
Right.
Yeah. And you can also sit down if you say, man, I want to do a teleconference. I want to do a phone call interview with Marcy to walk through this. I'm a newbie to the business on the DI side. Maybe I know securities. Maybe I know life. Maybe I'm coming we're seeing a huge exodus out of the medical because of
Right.
Obamacare. People are coming into our business. And you say, but I just don't know how to even start with this. I got a couple good clients. Marcy's the gal you want to talk to. Marcy, when I'm looking at any other writers that you
The
you
purchase
kinda like?
option is a very inexpensive rider, because when you exercise the rider is when the cost comes into play. And what that feature allows is it protects your future insurability. So you buy a pool of money or the limits that the carrier offers. Most carriers will issue $15,000 to $20,000 on their own paper. Some will participate higher than that, mixing it amongst carriers. So this allows you a pot of money for young professionals. As your income grows, you show your 1040 and you do not have to pay, you don't have to go through medical evidence.
And what kind of percentage did you think that was?
Well,
about?
it's like 3%. It's a dirt cheap rider.
Well, really, the
when
ones
you
you've-
bump your benefit up is when the cost comes into play at attained age.
Well, the one that so far the cost of living, the catastrophic, and the purchase option rider, seem to be decently priced. The only one that seems to be a little pricey is the residual.
Well, and that's that's built into some carriers, so it's just you can't even unbundle it. Otherwise, I think the more it costs, the more it does for you. The fluff ones don't cost anything.
Oh, I like that technical terminology, the fluff ones. Well, are there any other ones you want to bring up on the show that you think are worth, as far as riders, that you have to pay for?
Not really that you have to pay for, no. Those are really the riders, and I don't
Those
think
are
I'm
the big
missing
four.
the ONOC, the residual.
So like in my world of
COLA.
life insurance, I have this return of premium on a term chassis. Can I get return?
Thanks for reminding
I do.
me. Well, return
they
it.
say I
and you
don't
know
know
what? Because
DI.
nobody ever, it's rarely sold, I should say, because it is a 60% load.
Wow.
And what happens is, depending on the carrier, there's 3, I think, that sell that now. And either including the load, so let's say your premium's $1,000 a year, now your premium's $1,600 a year. Every 5 years you get $800 back. You get less claim. You get half of your premium you paid in back.
Well, the interest rate's so low, maybe I don't care.
Yeah, and they say the return on that's about 12%, but who buys term and invests the difference?
Nobody. Well, listen, Marcy, I want to thank you for being on our show again today and breaking out the riders and the ONOC issues. That's huge. Remember, you can talk to Marcy, 1-800-290-7226, extension 126, or write her at marcy@brokersalliance.com. Hop out to our website and visit us, www.brokersalliance.com, where you can always check in on life, disability, long-term care, and pension. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get into the zone. The Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.